Are you struggling with the CPA exam because your course failed to fit your learning style? I'm Darius Clark of I-75 CPA Review, where the right teacher makes all the difference. In this video, we're going to look at the basics of the income statement. When you think of the income statement, think of performance of the company over a period of time. Were the assets of the company productive? Did those assets create revenue? Just because you have revenue doesn't mean you were successful, though. Did that revenue create profit? Profitability is very important in assessing value of a business for investment purposes and for credit worthiness. You're more likely to qualify for a loan if you're a profitable company. And if you do qualify for that loan, your cost of borrowing will be lower if you have net income on your statement rather than net loss. So on the exam, you've got to be familiar with the multi-step income statement format, where there's a lot of subtotals. The first subtotal you see here is after revenues less cost of goods sold, there's a gross profit subtotal. Then after you subtract operating expenses from gross profit, there's an income from operations subtotal. And then from income from operations, we would add or subtract other income or expenses, gains or losses, and that would bring about another subtotal known as income from continuing operations before tax. So notice there's income from operations and there's income from continuing operations. Then we subtract income tax expense, and then there's another subtotal, income from continuing operations after tax, which would also be the same as net income or loss if there were no discontinued operations. But if there are any discontinued operations, then you would need two separate totals here. One for income from continuing operations after tax, and then once you added or subtracted your discontinued operations net of tax, you'd be down to the bottom line, the net income or loss. Let's try this. How is gross profit calculated on an income statement? Is it A, gross profit equals operating expenses minus revenues? No. B, gross profit equals net income plus income tax expense? No. C, gross profit equals revenues minus operating expenses? No. Must be D, gross profit equals revenues minus cost of goods sold. So letter D is correct. Gross profit is what you get when you subtract cost of goods sold from revenues. Revenues are from the primary business activities. Less cost of goods sold equals gross profit. And here's our multi-step income statement where you see where all the subtotals are. And the first subtotal we said is the gross profit subtotal. All right, what does income from operations indicate on an income statement? A, it includes all revenues, expenses, gains, and losses. No, that would be income from continuing operations. B, it is the profit from primary business activities before tax and other income/expenses. Yeah, B looks pretty good. C, it is the net income after income tax expense. No, we're looking for income from operations. D, it includes all revenues and gains, but not expenses or losses. No. The best answer here is B. Income from operations includes profit from primary business activities before tax and other income/expenses. Right here, here's our multi-step income statement starting with revenues, minus cost of goods sold equals gross profit, minus operating expenses equals income from operations. The profit from primary business activities before tax and before other expenses, other income, any gains or losses. That would be income from operations. Letter B is correct. Notice that there's a difference between income from operations and income from continuing operations. What's the difference there? Well, you'd have to include the other income/expenses, the gains or losses, if you wanted income from continuing operations. So good question. Expect one just like this. The answer is B. And you got to know something about every line on this multi-step income statement. So let's start with revenues, which is the top line. Revenues come from the primary business activity. Could be sales of product, could be rental income if it's a real estate company, or maybe services income like an accounting or law firm. Revenues we know has a normal credit balance, and it might result in an increase in an asset, such as cash going up or accounts receivable increasing. So with revenue, you might have a debit to cash and credit to revenue, or a debit to accounts receivable and credit to revenue. because revenues often result in an increase in an asset. But revenues could also result in a decrease in liabilities, such as unearned revenue, which is cash collected in advance, becoming earned. So if that happened and you collected a bunch of cash in advance, at the time you collected it, you debited cash and credited unearned revenue. And now that it's being earned, you'll debit unearned revenue and credit earned revenue. The account unearned revenue is a liability. And as the revenue is earned, that liability, unearned revenue, is decreasing. All right, which of the following is correct with regard to revenue on an income statement? A, revenues come from the primary business activity, such as sales or services, but would not come from rental income. Well, A starts out right. Revenue does come from the primary business activity, such as sales or services, but rental income could be the primary business activity also. And if rental income was the primary business activity, then it would show up in the top line on the income statement under revenues. So we can't pick A because part of it's right, but part of it's wrong. B says revenues often result in an increase in a liability. No, but it could result in a decrease in a liability. If that liability was unearned revenue, you could decrease unearned revenue when the revenue was earned. But B is wrong because revenue would not result in an increase in a liability. C, revenues often result in a decrease in an asset. No. Revenues might result in an increase in an asset, like cash or accounts receivable being debited when revenue is credited. D, revenues often result in an increase in an asset or a decrease in a liability. Yes. Letter D is correct. Revenues often result in an increase in an asset, such as cash or accounts receivable. Or revenues could result in a decrease in a liability, such as a decrease in unearned revenue. Now, what about expenses? Expenses are incurred from primary business activity, such as rent expense, insurance expense, payroll, utilities, office expense, depreciation. And when expenses increase, assets often decrease, such as cash, right? Debit rent expense, credit cash. But when expenses increase, assets such as prepaid expenses could decrease also, like prepaid insurance. If that was set up when the policy was first purchased, now when the insurance expense increases, we'll debit insurance expense and we'll credit or reduce the prepaid insurance. So we know that when expenses increase, assets often decrease. But when expenses are incurred but not paid for immediately, liabilities could increase, such as accrued liabilities, accrued payables. All right, which of the following is correct regarding an increase in expenses? A says current liabilities often decrease. Well, if an expense increases, that wouldn't result in a decrease in current liabilities, but it could result in an increase in current liabilities, especially at year end where you've incurred an expense but haven't paid for it yet. Then the entry would be debit to an expense and credit or increase to the current liability, like wages payable. B, current assets often increase when an expense increases. No, current assets could decrease but not increase when expenses increase. For example, cash could decrease if an expense is paid, debit rent expense, credit cash. So B is wrong. Current assets would not often increase with regard to an increase in expenses. C, current assets other than cash sometimes decrease. Yes. C looks good. When would that be the case? When would current assets other than cash decrease if an expense increases? Think of prepaid insurance. If prepaid insurance was set up as a current asset when the policy was paid for, now that you're incurring insurance expense, you would debit the insurance expense and credit prepaid insurance. So letter C is correct. When expenses increase, such as insurance expense, a current asset other than cash, like prepaid insurance, would decrease. What about gains and losses? Well, gains and losses are from incidental activities. They're not part of primary or core operations of an entity. The company might have sold property, plant, and equipment, but since that's not a primary activity of the company, they don't sell property, plant, and equipment every day, but they did sell one asset, so the result would be a gain or a loss rather than a revenue or an expense. All right, what is the primary difference between revenue and gains in the context of an income statement? A says revenue is the income from primary business activities while gains are the income from secondary activities. Yes. B, revenue and gains both refer to the income from the sale of goods and services only. No, B is wrong. Revenues refer to the income from primary business operations, which could be from the sale of goods, could be from the sale of services, and revenues could also be from real estate income. Gains would not be from the sale of goods and services, so B is out. C, gains are derived from investments only. No, gains could be from the sale of assets, not necessarily from investments. D, revenue is always larger than gains in a well-operating company. Not necessarily. You could have a one-time gain that could be huge. So the answer is A. Revenue is the income from primary business activities. Gains are the income from secondary activities, incidental activities. Revenue is generated from the core operations of a business, such as sales of goods or services, possibly rental income if it's a real estate firm, while gains are typically one-time profits from peripheral activities, like selling an asset for more than its book value because it's been depreciated maybe down to zero, and now it has no book value left. So you sold it, you have a big gain, but you would not want to mix that gain in with the revenues on the top line of the income statement because you would be misleading the users of the financial statements, and that's why we have different sections for everything on a multi-step income statement. All right, how is a loss different from an expense on an income statement? And if you think you know, leave me the answer in the comments section. And remember to like and subscribe because it helps the channel out a lot. And if you need more help with the income statement or any part of the CPA FAR exam, go to i75cpareview.com and get yourself on the right road. I'll leave a link in the description so you could get on I-75 with me, Darius Clark, because the right teacher makes all the difference.